Last week, we covered the question, should you buy the same policy design as your agent? It was an interesting discussion. This week, is the agent commission justified? In general, let's talk agent commissions, size of them, whether it's a big commission or a small commission. What can you justify as an agent commission, or what do we feel is fair? And we're going to kind of come at this from a few different angles. This is the Life Insurance Financial Education Podcast, where we're pulling back the curtain on high cash value life insurance and how it can help you build wealth and achieve your financial goals. I'm your host, James Barber, your Oregon Cash Flow Pro.
And I'm Carlo Viqueira with Net Wealth Finance.
We were discussing this before we hit record, and it kind of went a number of different directions already. So the title of this, we want to talk about, is the agent commission justified? And we were talking in relation to assets under management, and I kind of want to pull back and start from the very beginning. This is a product that people need to sell. Should somebody earn a commission to sell this product?
Yeah, I think one of the things that we can do is compare it to other industries that commissions exist. And some of the items that might come to mind for folks are purchasing a car or purchasing a house. Both of those tend to, not always, tend to have a commission involved. And what are you getting for that commission? What, in order to facilitate that industry without some kind of commission, what are the things that would come into play? Like it could be a difficult thing. And what is the value that you get from paying for that service effectually?
Yeah, and if you look at the different types of businesses around those industries, you've got all kinds of different business models. In the car sales space, Saturn came out, tried to do no commissions, like just flat rates. Tesla does flat rate. You get one price, no haggling, and those salespeople don't get commissions as far as I'm aware of. So there are different models that tend to work, but the one that is the most known and the one that permeates the United States is the salesperson, the scummy car salesman. Now, I used to be a car salesman for a few years, tried to put a good name in there on the industry, doing what I could. But there were some really shady practices that used to happen, which is why salespeople in general tend to get a bad name. And, the reality is nobody's working for free. So how are they going to get paid? And commission sales is one way that can really motivate some people to get out and get heard, share the product, educate people on the products.
Yeah, and it can really add value. So the really good car salesman who knows every feature, every package, every breakdown, that can really add value to somebody walking in. And maybe I'm the kind of person who, by the time I get to a dealership, I pretty much know what I want to buy personally. And a lot of it is just helping facilitate that, maybe connecting me to the finance department if I'm going to choose to do financing. Pretty simple stuff, maybe talking through their dealership packages, whatever it might be. But there's a lot of folks out there who don't just obsessively research over the vehicle that they're going to buy, and they need some advice on what direction to go. And that's where a good car salesman or salesperson can really add value to that transaction.
Now, back when I was in that industry, I could see commissions range from $100 all the way up to many thousands of dollars. And these were not luxury vehicles that I was doing. So there's a wide range of commissions that happens, but it tends to be the more expensive the vehicle, the more expensive the commission that you could get. Now shift over to housing. And usually the commission that the realtor gets is going to be a percentage of the sales price. And we're talking many tens of thousands of dollars in commissions that get paid out on those. That's a lot of money if you're changing houses regularly. Most people don't, but I think most people move once every 7 years or so. That's a pretty hefty commission that ends up getting paid out on their behalf. Oftentimes the seller paying the commission, but you can be sure it comes out of the actual sales price. So people are paying big dollars for commissions on products that they're buying. Where does life insurance fit into this?
I think it is one of those industries that I think even more so than cars or houses, there's an educational element to it. I'm not going to say that every agent or every person out there, but what is this? This podcast is about educating an audience. We're not necessarily going to work with all of you, but that's the thing. There is an element that we're trying to bring to the table in educating our potential clients or other people out there. And so most people are not just researching life insurance if they're interested in getting it. And I think that's why it is an industry that is well suited to some kind of commission-based structure.
Yeah, and there's multiple business models here. There are some people out there that will have never been exposed to life insurance or offered to get it without the incentive of an agent getting a commission, and then they're going and knocking on doors. It's possible these people would have never gotten a phone call, never clicked online and searched for insurance, and a salesperson came up to their door and educated them on the spot enough that they would buy a policy. Those things happen. And it may or may not be a good design policy as we would consider it a good design. It might be an expensive commission, but that doesn't necessarily mean it doesn't meet some type of a need that could be good for that person. Now, we tend to poo-poo bad designs just because we know that things can be better. But a lot of things that we consider bad designs, in the long run, they could still be okay. So it's not a matter of just people getting screwed because there's a salesperson convincing them to buy the product. At the end of the day, each person has to be able to run their own business. I talked about this with a lot of the people that I train, and even I bring it up with some of my clients because different agents might offer different types of designs strictly based on their business model. We design with the minimum commission because that generally means maximum liquidity and highest cash value in the early years and later on. But you might make a commission, you and I might make a commission that's only $1,000 or $500 on a policy. And if we only sell a couple of policies a month, you can't raise a family on that. So there's people that want to do life insurance as their full-time job. And if they don't have a mechanism where they can sell a whole bunch of policies each month, they simply can't survive if they're going to try and compete against the designs that we do.
Yeah, and I think that in those cases, there's generally going to be some element, and it's the relationship element or various other factors that they might bring to the table. I would still say, ideally, get an optimized design. I think, but there is, reasons why people might take that approach, and there is a significantly higher commission. And in comparing, when we've talked a number of times, we use this language of all base. So all of that base policy, whether that's whole life or IUL, tends to be the commissionable part of a life insurance policy. These permanent policies that will have a commission that is like 8 to 10 times the optimized commission, and that's huge. That is a very, very big difference, and really that impacts that early term liquidity. So that's why, in my mindset, we are thinking that having that optimized design is what's going to be best for our clients and best for our industry. So that's the way that I like to look at it too. Is it's a product that can work for almost anybody, because you'll hear a lot of folks in this financial space who say this life insurance strategy is really just for the ultra wealthy or something to that effect. And it's really not true when you have these optimized designs.
Well, it's the ultra wealthy that can afford to pay those big commissions without it really devastating the rest of their finances. Now, you mentioned earlier that when you go to buy a car, when you step on the lot, you basically know what you want already because you did all the research ahead of time. And the people that listen to this podcast and watch us on YouTube, they're kind of that same type of buyer. They're doing the research. So if you're listening to this, there's no reason why you should go pay an agent a maximized commission design, just like if you were to walk in to buy a car off the street and you did no research ahead of time, you might end up paying a really big commission. But if you did the research ahead of time, you know how to buy the right car and for the right price. You know what other dealerships are charging for it. They're not going to be able to hoodwink you. This is the value of doing the research, checking us out on YouTube, talk to multiple agents, getting different illustrations, and seeing which one can do the best design that will help meet your needs. Because it is possible that the commission could be 10 times less. The exact same product, almost exact. The only difference being reduced commission. So if you go to the car lot and you have a luxury car that you're looking at buying, and there's a car lot right across the street, same luxury car, but this one they're going to charge you a $10,000 commission, and over here they're going to charge you a $2,000 commission. How much commission you pay doesn't change how that car drives, but it might change how happy you are with it if something either happens to it or you find that you have to sell it real soon. You're going to find out how good of a deal you got. And it's kind of the same thing in this space. A lot of people, they'll start a policy, and if something happens financially and they have to cancel that policy, or they might need to tap into that cash value, you get an optimized design, you're going to be in a much better position to access way more cash, to pay less penalties if you needed to get out of it than you otherwise would with a bad design.
And that's really powerful. That ability to, in the event of the worst case scenario, walk away. That's why we like to design for the best. And a big part of that is optimizing such that it reduces the commission, which reduces those early expenses. So I think that is pretty key. I think maybe this is a good stepping stone to the financial sector. When people are thinking about maybe life insurance and hearing stuff from financial advisors, there's a lot of folks out there who will say that the commissions in life insurance are not justified.
Yeah, I don't generally hear that in relation to an optimized design. They're usually speaking in generalities. And the reality is, I would never buy an all-based design, something that has the maximum commission associated with it. The likelihood of success of those is just not good. Like, you don't have that emotional element where you get excited about putting money into a policy if it's really high expense and it's hardly turning into any cash value. So there is a valid argument that comes from a lot of the financial industry that says, don't waste your money. The only people making money in cash value life insurance are the agents that sell it. By and large, I guess that's true for most of the policies that people buy out there, because most of them are not optimally designed as we advocate for.
Yeah, and so a lot of folks in the financial space who are not necessarily trying to sell you financial services, they'll tell you to go to some low-cost mutual fund or low-cost ETF, and those expenses in those are really low, and you should, I think if you're investing on your own, those are pretty fine things to do. But the folks that are financial advisors or, your general fiduciaries that are out there that are not fee only, they're going to tend to be some kind of assets under management fee, which ends up being, pretty standard is somewhere around 1%. Oftentimes you have to have a certain amount to even get to that 1%. It might be as much as 2 or even higher percent for smaller portfolios. But 1%, I think, is a pretty standard number. And over time, as your wealth grows, that can be a hefty fee for the rest of your life, as long as that person's managing your money.
Yeah, and it's a lot easier these days to just avoid that altogether if you are savvy enough to go invest on your own. For a lot of people, they're not savvy, they don't know the market. They could definitely be helped if they want to invest in the market and that utilize the services of a financial professional, even though most of them don't beat the S&P 500 in any given year. It still could be worth it because they can get them to invest. They can help them through the emotional part of investing, which is usually the hardest thing, is being able to keep your money in the market when the market is being very volatile. So there is value that they bring to the table. But is it a situation where we buy the hype where it's like, totally avoid cash value life insurance, just put all your money into the market?
Well, that's the thing is there's some people who say that, and there's some people who say, don't touch the market, just put it into life insurance. And so I don't think either of those are correct. You should have a balanced portfolio of assets. And I think that life insurance, it has a solid place in most people's asset portfolio. And that's really what it comes down to. It enables a lot that you couldn't do with your normal accounts. And, an example that I tend to think about is if you're going to do some kind of, margin or S block securities-based line of credit with your brokerage account, you tend to have a lot less access to what's in there. So if you had, let's say, $100,000 in assets that were in nice, secure ETFs, like index-based ETFs, you might be able to have 50%, so $50,000 access to that. But if you have $100,000 of cash value inside of a life insurance policy, you can tap oftentimes like 90% of that, $90,000 or, somewhere around that in order to use elsewhere. And that's the real power of this strategy that can be in conjunction with your other assets.
Yeah, I've actually seen up around 98% of the cash value that can get access in some of my policies. So, and the nice thing about access that cash value in the life insurance is there's no risk of a margin call. If you actually do that securities-based line of credit and you borrow out the maximum that they will let you better be careful, because if the market decides to drop the next day, or if the brokerage firm raises their margin requirement, you could get a call. You could get a margin call and they need money right away. It could be the most inopportune time for you. So it's a really good idea to have that diversified portfolio where if we do need to tap into our liquidity, we have a safe place where we can tap into that we know we're not going to get that margin call. And I don't know about you, if you've ever been margin called, I have. It's a little bit scary. They sometimes will not give you any time to get money in there, and it's all controlled by them. You listen back to one of our earlier podcasts with financial horror stories, you're going to hear a really bad story about that margin call I was talking about, where they essentially gave me no time. Whole account got sold out from under me in order to meet this margin call before the market even opened, or shortly after it opened, before I could even talk to anybody. So a lot of risks when it comes to utilizing lines of credits places where you don't have the guarantees that you get from cash value life insurance. So I think we've justified the commission. Anything else to add there?
No, I think it really is important to understand that in these industries that have commissions, there is going to be some value you're getting from those commissions. And it's up to you to determine whether that's possible. In life insurance, for the most part, you're going to need somebody's going to end up burning a commission. It just tends to be the case. But I think it is justified, especially if you're getting some of that educational value and you're getting the optimized designs. You're listening to this podcast, that's what you should be getting.
Yeah, what I like to think about it is, what's a fair commission? Commission is going to get paid, but let's make sure that that number is actually fair to you, the client. Like, we've got policies designed that you could put in $100,000 and the commission is only a couple thousand. That's a pretty good return when you have no risk of loss in those products, and your money can only go up and compound. Well worth it in that case. That is an obviously optimized design, but that's all we focus on around here. Now, you mentioned, and we often mention, having a balanced portfolio. In that regard, next week, we're bringing you, we're going to make the case for utilizing whole life and IUL together. It's not one or the other. It's not whole life versus IUL. Whole life and IUL as part of your overall financial plan. That one's going to be a fun one. Be sure to join us for that. Thanks for joining us. I'm James Barber, your Oregon Cash Flow Pro, and I'm licensed for life insurance and annuities across the country.
And I'm Carlo Viqueira. You can find me at netwealthfinance.com or on YouTube at netwealthfinance. And we'll work with life insurance clients across the country as well.
Take care. See you next week.
Thanks for tuning in.
The next 20 seconds determine your future. Subscribe, meet with us, or continue educating yourself with these videos right over here.